The rapid and overwhelming shock of the global pandemic, as well as the restrictive measures taken to manage it, have sent the world economy into a tailspin. Because of how quickly it has traveled the world, countries have closed their borders, healthcare services are stretched past their limits, large regions are quarantined, and millions of people are self-isolating at home. And now, another challenge has once again popped up, and that is, a global economic recession seems to be heading our way. According to World Bank projections, the global economy contracted by 5.2% this 2020. This would ultimately become the worst downturn since World War II, with the highest share of economies seeing per capita output decrease since 1870. This is according to the World Bank's June 2020 Global Economic Prospects. Not only that, but economic activity among advanced economies is anticipated to shrink 7% in 2022 as domestic demand and supply, trade, and finance have severely disrupted. Per capita incomes are expected to decline by 3.6%, which will tip millions of people into extreme poverty this year. To make it easy and simple, things don't look good. While most experts say there's no need to panic just yet, there are also a number of data that have proven otherwise, which can help us signal future economic shocks. They're generally referred to as indicators or signs that experts read when trying to spot-check the health of the national economy. So to help you understand more, here's a breakdown of 5 signs that consumers should keep an eye on according to experts. Number 1. Rising unemployment trends. If there's one thing that you should know, is that a low employment rate is seen as a positive thing when it comes to the economy. This means people have more jobs and can support their family and lifestyles. This in turn creates more cash flow to the economy, as well as lower the poverty rates. One of the significant events was the unemployment rate in August 2019, which lowered to a 3.7 rate, which is near the lowest level since 1969. So if a recession were to happen, one of the quickest ways to see it is the unemployment rate. The Department of Labor often publishes the broadest measure of the job market every month. In this report, we are able to see a number of data points, including the percentage of the workforce that's unemployed and the number of jobs each sector has created. However, it's also important to analyze the employment measures businesses do. That is because one leading indicator among unemployment rates is the history of cutting the number of hours leading up to firing. According to some economists, one of the leading indicators when you know a recession is about to happen is when businesses are getting worried about future sales and end up cutting hours. If there is anything we can see with the past 2 recessions, it is usually accompanied with a high increase in the percentage of the unemployment rate. Number 2. Flattening yield curve. The yield curve is among one of the warning signals experts use to closely watch the impending recession. But before that, let's talk about what a yield is. It is simply the interest rate on a bond or treasury. These bonds and treasuries usually have differing lengths of duration known as their maturity. While some bonds last 1 month, others last over 30 years. In the financial business, the yield curve depicts the yields or interest rates for a similar debt contract over various contract terms. The link between the interest rate and the debt's time to maturity is depicted by the form of the curve in these graphs. A typical yield curve has lower rates on the left and higher rates on the right, implying higher rates for longer maturities. The yield curve, on the other hand, inverts and becomes downward sloping. Investors are demanding a higher yield for short-term treasuries as a result of this inversion. In this situation, people believe that holding their bond for a shorter period of time is riskier. As an example, the US plots treasury securities with maturities ranging from 4 weeks to 30 years. When long-term rates are lower than short-term rates, that's called an inverted yield curve. An inverted yield curve is usually a reliable predictor of recessions. Here comes one of the major shocks, and that is, for the past 10 years, the yield curve has been slowly flattening. Recently, in December 2018, the yield curve inverted. Traders, economists, and strategists all keep an eye on this curve since it has a history of predicting downturns. Most data is inevitably backward-looking in a world where economic indications are delayed. Inversions of the yield curve, on the other hand, have consistently predicted recessions during the last 50 years. Number 3. Gross domestic product. If there's one thing a recession basically tells us, and that is, the economy isn't growing, and the indicator of economic growth is measured by something called the gross domestic product, or GDP for short. What the experts usually look at is the output gap between the economy's actual and potential gross domestic product, which was one of the less reliable measurements, but still worth tracking. Monitoring this quarterly data shows signs of a flattering economy. One of the things that is also worth comparing is gross domestic product with economists' longer-run expectations. With this data, experts can know whether general fluctuations in GDP are any cause for concern, and it can also help you determine what the output gap is. An output gap is the difference between actual output and what economists believe in the economy's utmost potential is, and it can be positive or negative. According to a report from the Congressional Budget Office, real GDP, which measures growth adjusted for inflation, exceeded its potential in 2018 for the first time since 2007. When the output gap between actual and potential GDP begins to widen, it's possible that it's a sign of impending recession. While the GDP has decreased into the run-up to the last two recessions, it has also briefly fallen into negative territory twice without a recession forming. Furthermore, GDP has been largely steady in recent years with little evidence of change. Number 4. Leading Economic Index. Because most economic statistics are released with a lag, finding a forward-looking signal is difficult. In addition to other statistics, the Conference Board releases a 10 dataset index that forecasts the global economy's trajectory. They make up the index of leading economic indicators. The Composite Index of Leading Indicators, otherwise known as the Leading Economics Index or LEI, is an index published monthly by the Conference Board. It is used to predict the direction of global economic movements in future months. According to the Conference Board, this indicator includes average weekly initial claims for unemployment insurance as well as the prices of 500 common stocks. Some experts have recommended that taking a note of whether the index has dropped for 3 years in a row is worth considering the year-over-year decline. LEI fell for the first time in 2019 in June, but it's not yet time to panic. Although year-over-year growth hasn't been negative, it appears to have plateaued. The index did not move from April to May, and it only increased by 0.1% to 111.8 between March and April. Number 5. Confidence Indexes. Even in economics, how individuals feel is important. Consider the ongoing trade battle between the United States and China. The trade war formally began in July 2018 when tariffs of 25% were imposed on $50 billion worth of goods. However, the situation has worsened since then, with tariffs of 25% now in effect on an extra $200 billion in goods. Trade tensions in particular produces weak investment as well as weak manufacturing. It creates a significant effect on financial market conditions as well as on the economy. This is what we call confidence indexes, a consumer confidence indicator that provides an indication of future developments of households' consumption and saving. It is based upon answers regarding their expected financial situation, their sentiment about the general economic situation, unemployment, and capability of savings. There are plenty of studies available. The University of Michigan offers a monthly consumer sentiment index that includes 2 updates, a preliminary reading and then a final reading. The Conference Board, a membership organization for researchers and business people, provides its own index. Bloomberg also publishes a weekly consumer comfort index. Consumer confidence remains historically elevated, though it tumbled in early 2019 as a result of the lengthy government shutdown. It's since recovered and held stable. The bottom line is, don't panic. Predicting a recession is never a clear-cut signal, so paying attention to these indicators helps. No one can ever say with such precision when the next recession will happen, but knowing some factors can help you prepare and save up. In conclusion, there are 5 signals to look out for when it comes to recession: unemployment, yield curve, GDP, LEI, and confidence indexes.